All right, Hadar, welcome to the Real Estate Marathon podcast, man. How you doing?
I'm very well, thank you. Thank you for having me, Mike and Larry. It's much appreciated.
Yeah, man,
Thank
we
you for
are
being
pumped.
here.
We're super excited to have you on the show today, man. Before we get started, can you give the listeners just a background of kind of who you are, your experiences, and what you're doing now?
Yeah, sure. So I'm an American citizen, was born and raised in Israel, and moved to New Zealand in the early 2000s. I started as a real estate agent back in Israel, again in the early 2000s, and pretty fast realized that being on the investor side is potentially more lucrative than being just an agent working to get money coming in through commissions. So at the time when we moved to New Zealand, I was got into the country, trying to find kind of employments, what to do, and worked as a manual labor in the vineyard and orchards of Central Otago, if you like, on minimum wage. But that was the early 2000s, where the property cycle globally was really taking off and picking up momentum. And of course, it was all over the news and everywhere. And I really got attracted to the sector in terms of trying to educate myself, and started doing a lot of listening and studying while working as manual laborers. Back then, there wasn't any podcasts or anything, mainly CDs and those old MP3 players. So started doing that, gradually picked up momentum with wholesaling, did a lot of assignments and contemporaneous closing, which is double settlements, and slowly picked up momentum with flips, buy, rehab, and sell, and picked up enough deposit to start building my own buy and hold portfolio. Moving forward 16 years, close to 20 years really since I started, now I own a mixture of residential, small multifamily, if you like, in New Zealand, and commercial real estate, mainly strip mall commercial. At some point in New Zealand, in the last 5 to 6 years, the markets that I invest in, which is mainly Auckland, which is the economic hub of New Zealand, really matured. So the market matured, like, for example, Jacksonville, Florida matured recently in the last upturn, or Dallas-Fort Worth matured. The cap rates really compressed. So for me to grow my portfolio further for cash flow purposes, it was really challenging to actually get a proper return, which would support my lifestyle and my income goal, if you like. So as an American citizen, I started looking further afield and out of New Zealand, and started researching the markets in the US, and got to the point when I started acquiring properties and building a portfolio in the US of multifamily apartments.
Awesome. We definitely got to dive into that, because I know a lot of people are kind of have this notion of investing outside of their local market as a big concern and kind of scary. And you're investing in the U.S. from New Zealand. So we'll definitely dive into that for sure. But let's chat a little bit about how investors might get started in multifamily. So it can be super daunting. So what advice do you have for people who want to get into the area that might feel just overwhelmed with all the different areas that they could go with the real estate investing?
I think there are a lot of investors that want to start in real estate investing, but there's also a lot of investors that want to shift from single family to multifamily. And multifamily is obviously our niche. It's what we like to do. One of the reasons is because it has a multiple income approach. So you buy an asset and it has, the reason I'm saying it, because I want to make sure that people understand that it's actually less risky than buying multiple houses in different locations, because there is an economic of scale by owning a multifamily, or if you like, multiple income under one roof or in one location. They're easier to manage, and they are mitigating the risk by having 1 or 2 or 3 vacancies out of 20. It's not a big deal. You can still pay the mortgage and you can still receive cash flow. So again, this is strategy that we've chosen, because buying a multifamily property is basically buying a business, if you like, an underperforming business, which is what, for example, we are targeting, is underperforming multifamily apartment, which we could add value to and fix the property, reposition the asset, stabilize it, and create better income, higher income, and higher capital gain by fixing the problem, fixing the property and getting it perform better. One of the most important things for budding investors, whether you want to shift to multifamily or just start in multifamily, is getting educated. You really want to get yourself educated, whether you first start with listening to a lot of podcasts, for example, your podcast, the Wheelbarrow Profit podcast, and many other Bigger Pockets podcasts, many other great podcasts that could touch on that particular niche. You can read book, but at some point, I think that you should seek to join perhaps a community, perhaps even a mastermind group, or perhaps the Jake and Gino coaching program, which it's not just the education, but it's having the support and surrounding yourself with like-minded people. Because real estate investing could be quite a lonely business, if you like. Once you decide to go and you decide to run with it and to make it happen, you really need to have the consistent support for you to be achieving your goals. Because A, you need to learn what you don't know, so you're able to execute on the things that will propel you forward to achieving your goals. And B, you really need to be kept accountable and keep your motivation levels up. Because in this business, there are many, many times, it's like running, that many times that you're struggling. You know, when you run a half a marathon or a full marathon, the last section of the run, could be so difficult that you really, really need to work on your mental position to keep going. And as a runner, you know, so I like your name of your podcast so much. It really attracted me because I understand it. Having the support, having the mindset, and having the ability to understand that it's a long game and it takes time. My first deal took me a while, and my latest deal, which was a really good deal with a lot of meat on the bone, took me 18 months to achieve. So you need to be persistent and stay focused. So again, to recap on that, join like-minded community, seek some coaching and education, and also start small. You need to be prepared and understand that it's okay to start small. If you want to start with a triplex or a fourplex, it's fine. It could be something that you can learn, especially if you're going to a market on your own, if you're not partnering with any other investor and you're going to a market which is I started small. First, I bought a fourplex. Then I bought a triplex. And the reason is, and I'm taking little breaks because of the internet connection. If it drops a little bit, I take a little break. The reason is because you can actually go through the process of repositioning and getting to get to know your market even better, and your boots on the ground and your property managers and all your contacts which you're going to use to work on the property. You get to know them and experience the process on a smaller deal. So if you do a mistake, it's not going to be a mistake on a $2 million or $3 million or $1 million asset. It's going to be a smaller mistake on maybe 200,000 or 300,000 or even 100,000. So
yeah, I'm always a fan of taking your lumps on a smaller deal versus the bigger one,
Oh,
right?
yeah.
Learn on the smaller ones, but. Hadar, you had a ton of information. I want to unpack a few things there. What do you mean by the economies of scale? I think that's something that gets thrown out there a ton, but from a newer investor, especially coming from single family into multifamily, can you give me some of those examples of that economy of scale for that you might see in the 20 or 30 unit apartment complex that you wouldn't see in your single family?
Yes. The first thing is to take a step backward and look at your goals. So if your goals are to achieve a certain amount of income per month, you walk backward and you say, let's say I need to have $100 a month from one property, for example, for one door, to achieve my $10,000 a month income, if you like. So you will need to buy 100 properties, 100 doors, or 100 single-family homes to achieve that goal. Now that is 100 separate transactions. It's 100 time of negotiation. It's 100 time for obtaining finance, and 100 time of just keeping looking and all of that. While you can possibly buy 20 or 30 or 40 or 50 or even 100 in one transaction, one deal. So that really shortens your time frames to achieving your goal by focusing on buying in bulk. You're buying in bulk. You're able to buy those multiple incomes in one transaction. So that's number one, which is very important. If your goal is to generate cash flow, you want to be able to speed the process in opposed to looking for 100 deals. You can shorten it in maybe 2 or 3 or 4 deals.
For sure.
You manage to find 3 properties, which each one has, for example, around 35 goals, it's only 3 transactions. You can definitely achieve that in a year or 2 years, and you can achieve your financial goals. So that's the main reason, the first reason. Reason number 2 is the economy of scale of being able to, from a management point of view, to have more focus on one community, or asset management, especially if you are away, have focus on managing the community in one place. So if you have a maintenance guy, even if it's a 20 or 40 or 60 units, they know what to go. If there's a shed over there or storage place, they can store up a number amount of ceiling fans and thermostats or whatever you need to be able to service that over there. And you can pretty much process those efficiencies much more smoothly and easily. So you can buy in bulk as well, and you can get better return, better cost saving on flooring, on ceiling fans, on anything you want to buy, really, because you can buy in bulk.
Nice.
That's number 2. And number 3, of course, there are many other more bits and pieces that will be effective with cost saving. But even doing your financial returns, the CPA will do a financial return of one entity, which will cost you, I don't know, my one cost last year $2,000, let's say. So that's one financial return on one entity, in opposed to having millions of different potential entities that own a group of 5 here and a group of 5 there houses, for example. So there's many data. The main thing is the management. The management is easier when the doors are concentrated in one location.
That's a good point, though. I don't think the taxes and the paperwork and the legal work really get talked about a whole lot when economies of scale, but you're right. That's a big cost savings too. So
yeah. Nothing scarier than 100 different transactions with the IRS. Yeah. And for me, the 100 single family roofs is another daunting thing versus 8 different roofs under, for the same amount. So the other thing I kind of wanted to unpack was, you were talking about the coaching program, and that's one of the curiosities that I have that leads into our mentor discussion. How important do you feel that it is to get into the coaching programs and find a mentor to help you complete your first multifamily deal?
I think it's very important. And, when I first started, I joined Jake and Gino way back. I mean, it was almost 4 years ago now. And I learned a lot from the process. And I really think that this is something that I wish I actually have done a little bit earlier. Then it will allow me to have the confidence to get into deals earlier in the cycle, for example. I was very busy in New Zealand making money and doing transactions and doing what I've done. And multifamily as a whole looked like something which was the big boys game, only people with a lot of money, people who got really established kind of commercial experience will be able to do it. But that couldn't be further from the truth. If you learn the basics, it's not rocket science. And really learning from a mentor or an accountability mastermind group, like, for example, that we run, Marco and I, which is Marco and Gino's brother, we run the MIH Mastermind group, and we really help people to shorten the timelines for their success. So if you like, we keep them accountable, we educate them, and we are in a position that we help them to learn from our experience so they don't make those mistakes. For example, I just had a call, I mentioned to you just before in the green room, if you like, that I had a student rang me. He told me, he sent me a message on Facebook, urgent, we have to talk ASAP. Long story short, it's a possible deal with a few units that are completely vacant. And in today's market where we are with the current economy, which is pretty much past the top, and we are on the way down, really, in terms of the economic cycle of the real estate cycle, he didn't have the funds to purchase it, even if to put a down payment at this point. So I looked at the numbers. Theoretically, what the broker says makes sense that he could do it. The BRRRR strategy, which is buy, rehab, repair, refinance, repeat, there is enough meat on the bones considering the assumptions that the broker gave him. But If you go into a heavy lifting deal, which is completely vacant, 1930s building, which you don't have the money to pour, you're going to borrow 100% of the money, hard money. Excuse me, in today's marketplace, this is not something that I will recommend or encourage somebody to do on their own. I would, if you can bring, for example, 50% of the money, then you got lower mortgage payment, and you could potentially work it out and weather the storm if you can't fix it, if you're going to lockdown now and you can't even get the contractor to do the jobs, and then if people got fires from the job and they don't have the opportunity to even pay that rent assumption, which is on the high side, then everything can drag on for even 6 to 8 to 9 months. And he's going to have to carry those holding costs from cash, subsidizing that hard money lender for all that period. So, that's why I think that coaching and working with somebody with experience of being there before and could see the future from experience is very, very important. I just think it can save you a lot of grief and a lot of stress.
Yeah, you could have potentially just saved that guy from getting knocked out of the game for a couple of years. I can't tell you the amount of deals that I've brought into my coach and my mentor, who have kind of steered me clear of the deal that I thought, when in the front was a good deal, and we underwrite it together and go through it, and after going through it, turns out might have just saved me. He might have just dodged a bullet there from a bad deal. So no deal is better than a good deal. So
absolutely,
yeah, definitely key to have a good mentor on that one. So
guys, I just want to make a point. The key in today's marketplace, when we are at the top or even past the top, even through the boom phase, if you like, the innings, as some people call it, the key is not to be a motivated buyer. Because if you're a motivated buyer, you're going to overpay, you're going to get in, and you're going to get into a deal that it looks like it has a lot of meat on the bone, and maybe it does. But if it's not a good fit for you from various reasons, if you can't fund it with favorable terms, or if you're out of the location and you don't have a project manager that could do the job, is not to get into these deals, because we are in uncharted territory, and you have to be very, very careful these days with the way you get into deals. Do not be a motivated buyer, because you can lose your shirt, and that's something that I want to emphasize. I don't want to see people do it. And somebody helped me. Back in 2007, I was making good money or to buy a piece of land that I could subdivide and build a few houses on it, and the numbers look good on paper. But then the GFC came, the global financial crisis. And I had a mentor here in New Zealand, and he told me the numbers look good, but you may as well don't get into this deal, because it's a raw land. There's no income, and this is the same. The other deal the guy brought in, it's a completely vacant building. So if you get into a deal like that and you can't service the debt and you're borrowing a lot of the money, it could wipe you out. So you have to be very careful.
For sure. Yeah. All right. Last question for me before we get into some of the long distance real estate stuff. So people who are wanting to get into multifamily, how do you suggest they start? Is it wholesaling like you did? Is it single family working their way up? Do they just dive right into maybe a 10, 12 or 20 unit apartment complex? Where do you think the best place is to start?
I think it's really depending on the financial situation and the time they have available. So when it comes to the financial situation, if they're able and they have some money, maybe they can have some saving that they can contribute to, or maybe a 401k or anything they can use to get into a deal, they can potentially do it on their own. But again, it goes back to education. Education plus action equals results. So you really need to get the education implemented wisely, preferably with support of some mastermind group or coaching or anything like that, so they can guide you through, and then you can achieve the results. But if someone has the ability to maybe partner with the family member or a friend and do it together, so they can actually get in and make it happen and find some deals. And this is a process, of course, they need to learn how to research a market, build the network and the relationship, and start working on the market and focusing on that market. But if they don't have the means and they don't have the money to start investing, then they really need to learn the essence and the principle of being a good networker, because that is very important part of business in real estate. It's not what you know in the beginning. If you don't know, it's who you know, to help you to get education, but also at the same time to surround yourself with people that could potentially invest with you in deals. And for example, Marco, my partner on the MIH Mastermind group, is a master of networking. So he knows, and he helps our students as well, how to put together meetups and various communications through meetups. Now we're doing some Zooms. So people get to know you, and people know that you're a player. And there's many other ways that you could get some authority, if you like, even if you don't have much experience, to get yourself in a position that you can team up with people to raise some money. So if they don't have enough money, they should really start networking to be able to get into deals. Like I said, I believe that people should be able to go into deals. They could start small. It's very important to get your feet wet so you can build the confidence and build track record. In saying that, there is also an option, which is a valid option, to get into a deal, maybe a larger deal, as a passive investor. You can learn a lot by being passive, because if you invest in a partnership or even a syndication, you can learn a lot from the process just by being a passive active. Maybe you can be active. Maybe you can be a GP and handle something that you're good at. For example, the marketing, dealing, even asset management or anything like that you could add value to the partnership. So there's many ways to get involved, but I think that the education part is the key, because no matter what you do, you need to know what you're doing, and you need to keep the education going.
Awesome. Yeah, and I think one of the things I like that Gino said is you got to pay to play or seek to serve. So if you don't have the money, you better be prepared to bring your time and your expertise. So one of the things I wanted to discuss, you invest from New Zealand in the United States, and that's quite a distance. I'm not sure what the airplane ride is, 13, 18 hours, something like that. But what are some of the benefits and the negatives of investing outside of your local markets?
What's the benefit and the negatives? Personally, I don't see any negative, because I'm happy with what I'm doing and I'm feeling great. But let's say the challenging thing is that you can't attend a walkthrough at the drop of a hat. If a deal comes in, you can't go and attend. Or if you're doing some direct mail marketing or anything like that, if you're doing any direct mail marketing or anything like that, it's not something that you could say, okay, I'll meet you tomorrow, let's go and catch up. Now, I'm in New Zealand, guys. If you're in the United States, in the US, there is no reason that you can't tell them, yeah, I'm just out of the state at the moment, I'll come and see you in 2 days, and you jump on a flight or jump in your car and meet him tomorrow if you're only 5-hour drive or whatever. So, I have to put things in proportion. If I can take 16 hours flight, Larry, from New Zealand to Chicago, or about 13 and a half to Houston, plus other flights, to make it happen, some people could do it. It's all in your head. So you really need to realize that it's doable. So the downfall is that you're unable to attend those opportunities as they come immediately. But that's the only downfall, because when you start, obviously you're at a disadvantage because you don't know the market as well. You don't have relationship with brokers. You don't have relationship with lender, which is key. And you don't have boots on the ground. And you don't have a relationship with other fellow investors in that market. But what you could learn, and that's what we teach, and that's what I've been doing, you can learn how to build that team and build the infrastructure around you to help you to be successful. So if I got an opportunity now, I talk to my property manager or my boots on the ground, a friend of mine, who will go and do the walkthrough on my behalf. And if we can agree on the price, or if we can tie the property out, then I fly out and spend, $3,000 or $4,000 on the whole trip, really, to make it happen. So this is the key. There's no really, for me, there's only upside, apart from that specific of difficulty of being present. But I work hard and make it happen to be present, because you have to be present to be successful. So I have techniques and systems that I do to keep being present in that market, in any market that I operate from out of area.
Yeah, love that. And almost forces you to have better systems versus if you're investing in your backyard and you think you can just jump over there wherever you need to. Almost forces you to have a really, really good team and really, really good systems.
Absolutely. And I wrote an ebook about it, and have an hour presentation about investing out of area, which I've done for a conference that was taking place last year. If anybody wants it, I can happily give it for free. We can link it perhaps to the show notes, the link to that. It's a link on my website, the mfiholding.com website. There is a link there for the video course and the ebook. I teach and I go through the process, what you need, how to build a relationship. It's a long conversation, which will take us to a different route if we go there.
Awesome. What's that website again? MFI Holding?
MFIholding with a G.com. Perfect. And you will see on the homepage, there is a link to that course. You can't miss it. And we can leave a link for the course in the show notes if you like.
Yeah, will do. So perfect. All right. What are the biggest myths or the biggest things that people think about long distance real estate investing that isn't really accurate?
First of all, again, I think that thinking that it's not doable and that it's difficult. It is difficult, but it's doable, because obviously if I'm doing it from New Zealand, you could do it whether you're in the US, whether you're in Australia, or in anywhere else. So it's definitely doable. The other myth would be that it's only the big boys game in terms of too complicated, too hard to understand. It's not. It's actually pretty simple. And you can go and buy the Wheelbarrow Profit book, which is a 150 pages book, and learn the basics and get to know and get yourself familiarized with what is multifamily. So it's not rocket science, guys. If I can do it with the high school certificate, no university, no nothing like that, higher education, then you can do it as well. The second myth, I would say that people think I can't do multifamily because I don't have any money. So that's not true as well, because if you can add value to an investment group or to an experienced investor, like you said, Larry, that you could join a team and you could add value, and consequently will be part of an investment transaction or property deal. Also, you would be able to perhaps be in a position that through networking you're able to raise money and make it happen and get into deals. But you need to have the education, especially if you're going to do meetups. You need to have the education, because you need to be credible. And the only way to be credible is to know what you're talking about. And that's why the education is really important.
Well, I got to tell you, I have a local portfolio, and you're selling me on investing outside of my local market, because I amuse Mike on a daily, almost weekly basis when I tell him I have the I'm a do mentality, where if I have to run to do something at the apartments, I'm the one who does it, because I'm right around the corner and I should not be doing that. So I think that's one of the benefits, is to get it far enough away from me where I have to depend on other people, and then I can have the free time to look for other properties.
Yes,
so,
absolutely.
Now, for this kind of investing, the local or the long distance investing, do you feel that any level investor can do it, or do you think you need to have the experience of investing locally first?
Yeah, I always been investing out of area, even in New Zealand, because I live in a small town in New Zealand, which has 4,000 people, and there's just not enough opportunities. So even in New Zealand, when I started in an area which was 6 hours away drive. I used to drive there, and I can't believe that I used to drive and go back sometime the same day. Nowadays, I jump on the flight if I need to. And then even that market going too small for me, and it was Christchurch in the South Island I could drive, but then Auckland was in the North Island, which is a 12-hour drive and a ferry crossing, but then I fly there for 2 hours. So, I think it's all mindset, but it comes down to getting those relationships built in the market, so you can actually pick up some traction within the market. So once you get to learn the market and you get those foundations, understanding of the market, there's many ways to establish that. It's totally doable. When you invest out of area, though, you need to be prepared to visit the market on a regular basis. So if you're in the US, if you want to invest in a market which you could drive to, let's say 5, 6, even 7 hours, something that I don't like driving so much. So it's just not something I enjoy. Every time I go to Arkansas, usually I drive, but it's short drives. But if it's anything more than 5 hours, I like to 4 hours. I'll fly. But if you can drive to the market once a month, at least, to put your face in front of brokers, in front of lenders, and in front of fellow investors that you met through networking group that you came to see, or even jump on Bigger Pockets and see who is active there and ask to meet with them. That's how I make my friends in Arkansas. It's all started from one private message on Bigger Pockets. And now I have a lot of friends there, and very good friends. And so you need to be prepared to visit at least once a month. And if it's closer, even every 2 weeks. In my view, if you are like out of the country, then you need to be prepared to, in the beginning, to visit every 2 or 3 months, and every time to come for like 2 or 3 weeks. So you can really be present in that market. You want to learn the market. You want to be driving for dollar. You want to be subscribing to an online publication that has like the business news. I subscribe to a business news publication that states the news about the local business economy, what lenders are moving in, what lenders are closing shop, which deals are closing multifamily, what businesses are moving in and what businesses are expanding. So you really want to know and keep your finger on the pulse of what's going on with that market. Because once you stay in that market, and that's another mistake that a lot of beginning investors do, they spread their focus on too many markets at the start. It's very important to be focused on one market. One market, get to know it intimately, get to know the players intimately, and your relationship building intimately, so you can really immerse yourself and be present in that market. I know in my market the location very intimately, and I also know through my market research for doing enough market leads, if you like, to get a list of so I'm able to do direct mail marketing or cold calling. So I know which players in the market, few families that owns the majority of the properties over there. So for example, I got a guy who's separated on different community in different locations, which now I know him on a first name basis, and we had dinner when I was there last month, and we really on really good terms, and few others like that, because I reached out to them with letters. I built a document which basically cataloged the properties, the addresses, picture, how many units, how much they paid for it. And then by talking to them now that I know them, I even know if some of them are cross-collateralized. And I even know, for example, if some of them are paid off. So I know all of that. And I keep that in my Dropbox, if you like, as a long-term relationship, possibly going to come up an opportunity kind of situation. So you really need to impress yourself in that market, to know your market intimately, network, build relationships. And another tip for budding investors, avoid the shiny object syndromes. You do not want to start thinking about doing other strategies and list options, or I'll do a little bit of this, a little bit of that. It's just not going to work. You want to focus on one thing and go, and that's how the success comes, when you focus your goals and your strategy on one single thing.
Awesome. Love that, man.
Yeah.
All right. So we got to ask you, this is, what is this? March of 2020, right? And we have a little bit of a pandemic going on. What do you foresee the impacts to this COVID-19 having on the multifamily markets?
It's very hard to say, but I think it comes down to what's going to happen with people basically being able to pay the rent. The biggest problem we're going to be is delinquencies. So, and I don't want to open my mouth so early, but I mean, I talked to that guy actually, the friend of mine who had the 650 units, and I emailed him and said, we should be safe and everything. And just generally speaking, so far, what have you seen in terms of delinquency? And he said that out of 650, he only had about 5 people reaching out to say that they might not be able to pay on time. So I mean that's less than 1%. If you want to calculate, we had 2 people out of one community. In one community, we had 2 people out of 45. So what we do is we basically wipe off the late fees, so we don't charge late fees, and we are willing to. I hope that they're not going to listen to it, that's for sure, but to this recording. But we will be willing to do some concession and payment plans, and perhaps even in worst case scenario, drop the rent by a certain amount so they can weather the storm. So what I'm seeing with the COVID-19, generally speaking, as investors, we're going to see people who basically unable to pay the rent. So we're going to have a lot of delinquencies. That will probably start being obvious later on, not right now. Now we are in March. I think it will be more obvious in the April and May. Even May and June will be more obvious. The government is saying that they're going to contribute some kind of allowance, if you like, the $1,000 or $1,200 to tenants. So we reach out to the residents and telling them that they will appreciate communication, but also if they can use that money from the government towards rent, toward the rent payment. So I think that will be the big number one problem that we're going to have, and that will start rolling to different stuff. I mean, if you have maintenance guys that are sick and they cannot go and service the apartments, it could cause a ripple effect in terms of your operation. But in saying that, I think that sensible people do know that we are all in the same boat and everybody wants to keep safe. And I think the focus now should be on tenant retention and not increasing rent. I mean, my latest acquisition, we had about 20% vacancy. We managed now to rehab all the vacant units, and now we are basically filling them up at market rent. And the next step of the management plan was actually to approach all the existing residents who are below market rent and then turn them. So now I'm not going to do that because we had a lot of loss to lease this. So we had taken rents from $450, $445 to $595 to $625. We had about 35% loss to lease. Loss to lease, if anybody doesn't know, it's basically the difference between where you are getting now in rent and where market rent. So for example, if you are getting $100,000 a month, for example, rent, but the market rent is $150, so that $50,000 extra, that's your loss to lease amount. So we also calculated in percentage. So I'm not going to push on now, unfortunately, to get that extra rent because those people are not going to be able necessarily to pay. And it's going to be possibly delaying my refi and roll strategy. I was hoping to able to refi and roll this deal, which I could, even within 6 months of acquisition, because we had momentum and we could possibly do it. But now we can't do it. And another thing that, because we're not going to have that income high enough. Another thing that we going to do is there's one unit which had a fire in the kitchen. For example, we're not going to renovate that. So now we are all focusing on capital preservation, cash flow preservation, have enough reserve, and really have, to be in a position that we can weather this storm. There's few points I can share with you and the listeners, if you like, about how do we really go across and think about mitigating the risk. Would you like me to share that?
Yeah, let's dive in. I'd love to, if anybody how could this apply for anybody potentially looking to purchase in this market as well, for sure?
Yeah, so, to purchase in this market, I'll start with that. I think that, going back to the point with the student that wanted to borrow to the hilt, if you like, I think now it's the point to, if you can get into a deal now, you really want to bring enough money down cash. And if you can't afford it on your own, get a partner to put the money in. So preferably, if you can be at 60% loan to value, that's a comfortable place to be. I would go in 70 as well, but I mean, 60% is a very comfortable place to be. And I don't think you'll have problem raising finance, getting finance from lenders if you go in with that kind of down payment. So that's number one. And point number two about people who want to get into the market right now will be to be in a position that you underwrite the property very conservatively. So you really want to underwrite the property on higher vacancy. We are underwriting at stabilized 20% vacancy as well, just to make sure it stacks up. You want to underwrite at no rent increase. You don't want to assume any 3% or 4% or 5% rent increase. You even want to allow for a minus 5% in the next year of rent growth. So even rent decrease, if you like, even higher. So those are the main two things that in underwriting I would look at. It's basically the higher vacancy and lower rent, no rent growth at all. That's for sure. If you go in to buy, try and negotiate as long as you can interest-only period, which is one of my plans. If things are not improving and I'm getting down closer to my 12 months first initial period of interest only, which is 12 months, I will be going back to the lender and telling him, listen, we want to extend we would like to extend the 12 months to another 12 months of interest only. Because when you underwrite the deal, and that's something that we did, you want to make sure that your break-even point is very, very good in terms of very low. So you can have, let's say, even 30 or 40% vacant units, vacant, unpaying, meaning not necessarily physical occupancy. I'm talking about economic occupancy, which is basically having bodies, having people, having residents there who can't pay. So you want to do a break-even point of, even 40%. So if you can produce and be breaking even, I think you can weather the storm. So those are the first few tips that I will do when underwriting. Basically, higher vacancy, break-even point, which will be based on even 30 to 40% economic vacancy, and the point that I mentioned that was not increase in rent. So those are and rent decrease. That's the three main points. Now is the time, whoever owns properties right now is the time to lock those rates long term. Lock the rents as long as you can. That's number one. Lock those rents for 10 years, even, whatever you can, 5 years, 7 years, try and get as long as you can, as lower as you can right now. Number two, so that you have enough available cash, so you have a liquidity position for a rainy day if you need to prop up the loan, and have if you want a reserve account. So you can basically tap into those reserves if you need to top up the loan, or even if you have a major disruption with the problem in the property, like a fire or something break that you need to fix. You want to have the cash for that. One of the ways to have liquidity is to have a line of credit. You want to apply now, right now. Do not delay this. To apply for a HELOCs, whether you can get a business line of credit, whether you can get, Larry, line of credit on your assets in single families or whatever you want in your market. You want to top that to the maximum that you can get right now. Because don't forget, with line of credit, you are not using the money until you withdraw the money. So basically, you might have a $10 a month fee or something just to keep that facility open. But having that line of credit, it's like having liquidity, because you can use that equity, that cash, if you need it. Again, I would like to emphasize having reserves of at least 18 to 12 months for your living expenses. And you can have that as well from line of credit. So it's very important. Sell underperforming assets. This is something that I actually done and suggested to people to do before the coronavirus. We had a few students in the mastermind who live in New York. And since they joined the mastermind, we encourage them to sell those assets if they choose to, if they want to, because they have a lot of equity in them. Not just for the reason of coronavirus, because coronavirus wasn't on back then. It was really small. Because of the change of regulations and landlord friendliness in the city of New York and the East Coast and Oregon and all those places where it's really more pro-tenants. So there is many ways to get liquidity, but underperforming assets, it's good time to get rid of them. Now it's difficult. Now you can't do it. You can't get rid of those assets because you can't even do open homes. You can't show them. It's a problem. So now a line of credit will be more appropriate. That's number two. Sell underperforming asset. Another point, whoever is investing here with commercial property is if you have assets which are has commercial leases on them, you fix leases for 5 years, for example, you want to renegotiate with your tenants if you haven't done so before and have 8 to 12 months notice to your tenants that they need to give you before they take the right of renewal or the option to renew. So how it works on a nutshell, a tenant would have 5 years and then another 5 years, 10-year lease, but it's actually broken into 5 years and 10 years. But towards the end of the first 5 years, they need to give you notice if they want to take on the next 5 years. So most leases are like maybe 2 or 3 months notice. This is not enough. For me, it's not enough in any market with commercial property because commercial property can sit vacant for a long time. But especially in today's market, you want to have that notice for 12 or 8 months so you have enough time to look for another tenant. So this is very important, especially with triple net leases. Triple net leases means when the tenant pays for all outgoings. And these are my main points that I would really suggest people to focus on and keep in mind in this part of the cycle.
Awesome. Good stuff.
And I know what you mean about New York. I live in upstate New York, and it's one of the least landlord-friendly states out there. So that's what we're looking to do, is sell our portfolio and move somewhere more landlord-friendly. Well, this has been a great episode, Hadar. This is so informational. Can you let the listeners know where to go to follow you and find out more about what you guys do?
Sure. So we are, like we're saying, I'm actively investing and also producing a lot of content, educational content regularly on my YouTube channel, which you could link through my website. I do videos every 2 weeks. If you want, please come and subscribe to our YouTube channel. The link is on the website. My main website is mfiholding.com, which you can link in the show notes for that free giveaway that I have about investing from out of area. And my other venture right now, a business, it's the MIH Mastermind, the Make It Happen Mastermind group that I run and co-facilitate with Marco Barbaro. We have small groups of, we basically focus on helping investors to achieve their goal through multifamily real estate. We have a few other investors there that owns large amount of doors, like $250, $500. And we also have budding investors and people who want to shift from single family to multifamily. And we structure the group accordingly that everybody could propel their success. And it's really great platform. If anybody needs help, it's very cost effective and low barrier of entry. And we're really excited about helping people to do that. So the website for that is the MIHmastermind.com. Over there on the website on the top, there is a link for another ebook that I wrote about the real estate cycle, the different phases and the strategy of each phase. So if you're interested in that, feel free to jump there as well and download this free ebook and make it happen. So, we are here to help whoever we can to achieve the goals.
Awesome. Couple really, really key resources there. So appreciate you providing that to the listeners here, man. Other than that, Larry, anything else from you?
Oh, no, this has been a great episode. I've got a lot of information I've got to ponder over and think about questions for the next time we can have Hadar on the podcast.
Yeah, Hadar, we appreciate it, man. Thanks so much for joining us.
I would love to, and thank you for having me. I really appreciate the opportunity, and stay safe.
Yeah, you too. Thanks, man.